Hi everyone, welcome back to G2's weekly market update, where we break down the top global market stories and what they mean for investors like you. Let's dive right in. Starting with the United States. Markets ended the week lower as cautious signals from the Federal Reserve weighed on investor sentiment. The Nasdaq led declines, slipping 0.65%, while small caps saw their first weekly loss since early August. The Dow was little changed, but energy stocks outperformed thanks to higher oil prices after President Trump's push for the Europe to cut Russian energy imports. Fed commentary took center stage. Chair Jerome Powell noted the economy is in a challenging situation, highlighting upside inflation risks and labor market concerns, while also flagging stretched equity valuations. Several Fed officials echoed hawkish tones, cooling expectations for rapid rate cuts. On the data front, August core PCE inflation rose 0.2% month on month and 2.9% year on year, steady with July and in line with forecast. GDP for quarter 2 was revised up to 3.8% thanks to strong consumer spending. Meanwhile, PMI data showed activity slowing modestly but still expanding, and new home sales surged to their highest level since January 2022. Treasury yields ticked higher on the short end, reflecting lower expectations for aggressive rate cuts in the near term. Over to Europe. The stock 600 was little changed, though country indexes posted small gains. Investors weighed interest rate policy shift, trade tensions, and mixed economic data. The Eurozone PMI hit a 16-month high of 51.2, led by services, but manufacturing showed weakness. In contrast, the UK PMI slipped to 51.0, with auto industry disruptions weighing on output. German business sentiment declined sharply, though consumer confidence showed slight improvement. On the policy front, Sweden's Riksbank cut rates to 1.75%, its third cut this year, while the Swiss National Bank held steady at 0%, noting inflation remains well within target at just 0.2%. Now to Japan. Japanese equities rose, with the Nikkei up 0.7% and the Topix gaining 1.3%. The 10-year JGB yield edged up to 1.64%, near 17-year highs, while the yen weakened toward 150 per dollar, pressured by US dollar strength and political uncertainty ahead of the LDP leadership election. Tokyo inflation came in softer than expected at 2.5% versus forecast of 2.8%. While subsidies explain some of the weakness, the result tempered expectations of an imminent Bank of Japan rate hike, though minutes from the recent meeting show the central bank remains open to action later this year. And finally, China. Mainland Chinese markets extended their rally, with the CSI 300 gaining 1.1% and the Shanghai Composite inching higher. However, Hong Kong's Hang Seng fell more than 1.5%. There were no major data releases, but liquidity driven buying and strong household participation continued to lift A shares. Optimism was also supported by domestic AI breakthrough and Beijing's campaign to curb excessive price competition in industries. Still, underlying growth and deflation pressure remains a concern. G2 takeaway. This week highlighted how central banks and policy signals are driving markets as much as the hard data. In the United States, steady inflation and strong GDP give the Fed less urgency to rate cuts. In Europe, diverging growth paths show how fragile the recovery remains. Japan is balancing weak inflation data against political and currency pressures. And in China, markets remain liquidity fueled even as fundamentals look fragile. For investors, staying nimble is key because policy, sentiment, and politics are setting the tone as much as earnings or data prints. That is your G2 weekly market update. If you found this helpful, do not forget to like, share, and subscribe and follow us for more insights. And here is a question for you. Do you think the Fed will hold steady or surprise markets with a cut before year end? Let us know in the comments. Thank you for tuning in. We'll see you next week.